Welcome back, America. I'm Hugh Hewitt. I mentioned this story yesterday. I wanted to talk today with Ty Lasater, a great sponsor of our show from Key City Capital. I'm also an investor with Ty and Key City Capital. The Fetching Mrs. Hewitt and I are. They take in significant investments. They invest them in apartment complexes. They upgrade them and they keep them and they sell them after a few years. Good morning, Ty. How are you?
I am good. How are you, Hugh?
Great. KeyCityCapital.com/Hugh. Ty, here's the story. A tale of two housing markets. Prices fall in the West while the East booms. This is in Tuesday's Wall Street Journal. Every major housing market west of Texas, plus Austin, has seen prices fall in January. The opposite happened in the rest of the country, meaning East. So the boom is still on. Is that true in apartment pricing too?
Well, in rentals for sure. I mean, in the pricing of the properties, we're seeing the prices go down a little bit just because of interest rates. So as we are looking at new properties to buy, the prices have gone down because interest rates are rising. It compresses the buying pool a little bit. Less buyers are able to buy. But I think what we're more interested in is rental rates are still on the rise. Rental rates are heavily on the rise. And I don't see where it stops. What we're following is supply and demand, and we're still at a 30% deficit to supply, or with the supply in most of the markets that we're in. Most of the markets we're following growth markets. We've got still heavy job relocations, corporate relocations to the markets that we're in, and so we're seeing those rise.
Now, Ty, let me pick up on the reason I brought up this story. If housing prices are going up in red states, east of Colorado, that's what it says. Real estate markets east of Colorado are going up. Still, west of Colorado, they're going down. If housing prices are going up, that must mean rental prices are going up. Right? There can't be that. There's a discount for living in an apartment, but it's not that much. And if it's going up in housing, it's going up in apartments.
Yeah, no, it's not that much. And what we're seeing is builders now are only building, they're not building the entry point home. So that inverse relationship is continuing to grow greater and greater. As builders move towards more higher point homes, they're building the $750,000 to $1 million homes because that's where their margins are. And so there's just not enough of that, what we call entry product. And we're seeing more and more people want to rent. You've got the ability to really work from anywhere now with a lot of jobs. Now, still some of the jobs you see Elon Musk coming out last week with Twitter mandating, making sure that Twitter employees are at the office. We've got a lot of businesses that are coming back to in office, but PwC sold a bunch of their real estate, and they're telling their accountants that they can work from home, they can work from anywhere, or they're on a client maybe. And so you've got a lot more people renting. They want to rent and they want to have the flexibility to maybe be in one or two different markets and travel back and forth, but they don't have the ability to own two homes yet. And so
now, Ty,
it's really.
I got to ask you this because I've seen it on Twitter. A lot of people are trying to get into your business. Your business is pooling investments to make limited partnerships and buying apartment complexes, and everyone shares in the rental income. And if there's a profit at the end, they share in that. I have now seen on Twitter, become a real estate investor with that. And I won't touch things that I don't know. That's why I'm with KeyCityCapital.com/Hugh. Have you seen that? Are other people trying to reinvent your wheel?
What I'm seeing is that it's the education space, and it may be more prevalent once you get involved with operators like ourselves. You see the coaching and stuff. And so obviously there's an entry point to get in as an investor into our funds. It's $100,000 minimum investment. You got to be an accredited investor. And for those people who don't maybe fall within that, but they still want to own real estate, there's coaching programs. And we offer some as well where people can come in. We teach them how to get into that space and give them some guidelines and parameters that help give them a safe entry point into the real estate ownership market. And there's still a large demand for that. And so that's probably what you're seeing more of. It's educators that are coming in saying, here's how you get into real estate. I'll coach you and teach you how to do that.
Some that I've noticed are medical office building. Now, I wouldn't go for that market niche myself because it's awfully specialized and doctors move when they don't like the economic. I like rent. What do you call them? B properties? Is that what you buy? B properties?
Mostly when we're buying an existing property, it's a B property. Some of our new construction is A properties. But it's in a B market, so it'll turn into a property within about 10 years. But yeah, those are the ones where when the market is high, you've got your workforce housing living, or your workforce employees living in the product. When the market is low, and what we're seeing now is a little bit of tenant turnover, and you start seeing the people that were living in the A-class properties move down to the B-class properties. And the risk is in the A-class properties, and then obviously in war zone properties. You don't want to be in a war zone where you don't feel safe at night.
I got to tell you, Ty, more people ask me about Key City Capital. I say, I'm a sponsor, I'm an investor. And they say, yes, I'm prejudiced, but I think it makes a lot of sense. Thank you for joining me. I hope I see you in California sometime. We were supposed to get together last month, and then we didn't. Someday our paths shall cross on other than the video. KeyCityCapital.com. Thank you, Adam. Thank you, Jacob. Thank you, Dwayne. Don't go anywhere, America. Stay tuned to this great radio station. I'm Hugh Hewitt.